Hi, everybody. It's CryptoBurb, Adrian speaking. Welcome to another episode of the Nest Show podcast. This series, it actually continues to bring very big personalities from the crypto world, but not only from the crypto world, because today we have a person who is actually going to talk to us mainly about stock market, mainly about stock dividend market, which is super interesting to actually get a deeper dive into. But long story short, the good, very good person who I really want to get introduced to our beautiful audience is the very dividend hero, as we know it from Twitter, or Ross in the very person, who's going to actually talk to me and talk to you guys about the markets, about the market outlooks, about what is actually cooking somewhere behind the scenes, what can be perhaps expected in the months to come, and as well as his own personal best strategies, entry triggers, how it actually just operates on the back end. So if you guys are ready, make sure to give it a deeper check. We're going there right in a second. And to kick it off, I want to get some more personal information from you in terms of what Dividend Hero means, like how it's all kind of like started to you. What's your story, man?
Yeah, absolutely. Thanks for having me on, Adrian, by the way. This is great. Yeah, so I started investing when I was around 18. So I'm 24 years old. Been investing for 4 or 5 years. I certainly don't claim to be an expert. I'm here to learn as long here to learn with everybody else, right? So I don't preach that I know everything, but I love to help younger investors and things like that. So been investing for a few years and followed some of the Twitter accounts from my personal Twitter account, right? And then I started my Dividend Hero account in May of 2020. So I'm coming on 2 years of my account and I'm at 53,000 followers. Never in my wildest dream could have imagined that I'd be here. And it's been a great,
Congratulations.
great journey so far. Thank you very much. So when I made my account, kind of just had to pick a name that sounded good, right? Everyone had a name, and I wanted it to be my name, right? So I picked Dividend Hero, and I think at the time it was just, well, let's just see if this sticks, and it ended up sticking. And my thought process behind that was really just I'm a long-term investor, and I learned a lot about investing from my dad and from some courses at college, and dividend stocks interested me, and so it's just kind of how the name came about. It just came to me, and I'm like, well, this sounds pretty cool. Like, let's roll with it. And
It
I've been
does.
able to grow my brand over the past 2 years, and now people know it. That's awesome. So I full disclaimer, I own growth stocks. I own some crypto. I don't just own dividend stocks, but if you had to hold my feet to the fire per se, or if I had to stick to one strategy, I'd be leaning that way for sure.
I love it. I love it. I mean, I'm just having a look at Twitter. And of course, just like I said, very big congratulations to you. I think it's already a huge milestone to actually get recognized by so many people. 50,000 people, if you think about it, is a proper army. Like, it's a full stadium of people, right? So if you somebody made me just kind of like realize that the other day, where we were exchanging the thoughts over the social media stuff, and I realized that it was like a proper army, proper stadium of people. So well done to you on that, Ross. And I'm following your Twitter bio, and it says, and I quote, teach a man to trade stocks, he will be rich for the day. Teach a man to invest in dividend growth stocks, he will be rich for a lifetime. Talk to me about that.
Yeah, absolutely. Well, there's a famous quote that says, "Teach a man to, or teach a man to fish. Um, he'll be fed for, or give a man a fish, he'll be fed for a day.
Yeah,
But if
yeah,
you teach a man how to fish, he'll be fed for a lifetime, right?"
true.
So I just kind of modified that, and it was just like, if you teach somebody how to trade stocks, they might be rich for one day and then they lose it all the next,
Mhm.
and then but if you teach somebody how to invest over a lifetime, um, you know, they can be rich for a life. Buy dividend growth stocks, they can be rich for a lifetime. So kind of catchy, and some people say it's stupid, and some people think it's funny, and I've just kind of kept it. And I'm not big on bios. I don't know. Just
Mm.
I feel
Yeah,
like
yeah.
everybody's bio has all their accolades and things like that, and that's not what I'm here to represent, right? I'm not here to brag about anything I've done. So I'm gonna keep it with a funny quote and keep it kind of lighthearted. And I think a lot of bios are like, grew this e-commerce brand in 6 months to 3 million in sales, and $8 million portfolio, and it's like, all right, it just doesn't impress me. Like,
Mhm.
doesn't impress
I
me.
often, yeah. Well said. I agree with that. I often see you actually tweet it this way, that you actually keep posting one and the same theme, if you will, get rich then get off the grid, right? And that's something I can personally relate with. Well, of course, to the 99.9% extent, I think in every single case out there for everybody, being a trader, so proprietorship, kind of like representative, like investor, dividend investor, no matter how you refer to it, there's always going to be some kind of like a different interpretation to it, right? Because for one people,
Mm-hmm.
for one side of the people, traders is going to actually, more about like, getting their rich life, somewhere over, just there on the like, private jets and the jet skis all days and their own boats and yachts and so on. And for the other people, it's more of a countryside kind of like peaceful life. Which one is yours?
That's a great question. Definitely a little bit of both. One day when I'm rich, I will definitely have a sports car or a really nice boat or some kind of way to enjoy my life. But just a little background. The get rich and get off the grid. It just started as just a plain tweet many months ago. I just tweeted that out, and it when my account was less than 10,000 at the time, but the tweet did really well at the time, considering how big I was. And I was like, oh my gosh, like, all right, this is cool. So then I tweeted it again with a picture of a house, and then
Mm.
it did good. And I was like, all right, like, this is kind of doing good. Like, let's do it again with a different house. And one of them went viral. I mean, it got like 15,000 likes. And I was like, okay, all right, like,
Nice.
wow, this is awesome. So then I just kind of started doing it and kept posting, and every single tweet seemed to get like 1,000 likes, and everyone was giving their
Mm.
opinion, and they all did well. So now I just stick with it, and I probably tweet that once a week, and um, sort of just like a running joke, sort of just I
Mm.
know people don't like it, so I keep doing it just to stir the pot. But in all honesty, it's more of a get your money right, get rich, do what you got to do. But being rich and famous isn't the life for me. I want to have
Mm.
all the money in the world, and I don't want anybody to know about it.
Mm.
I want to just live my life and go get off the grid and go hike in the mountains and go fish in lakes and go camping and go do literally whatever I want to do, but and have a lot of money, but I
Mm.
don't want my name in the headlines and everybody knowing, right? So that doesn't mean just everybody interprets it differently, which I love, which is
Yeah.
great. I love just people get so upset that there's lights on in the house. And like, oh, you have
Oh.
electricity, like you're on the grid. And I'm like, dude, the grid just means something different to everybody. Like, I'm not going to
Uh-huh.
delete Twitter and go monk mode, but definitely, I mean, disconnecting from Twitter for a weekend or even for a day is great. It's good for the soul.
True.
Just get out and live your life. There's a lot more to life than Twitter. And I always say, I don't tweet about this a lot, but I always tell people when I talk about it, is like, the people that have the best Twitter accounts are living really good lives outside of Twitter. Like, if you aren't living life, you're not going to be having fresh ideas. You're not going to be creative.
Mm-hmm.
Like the people that have interesting lives and aren't just on their screens every day are always
True.
bringing something fresh and new to the table and new ideas and perspectives and stories and experiences and bringing those connections to Twitter. And that's where the cool accounts happen. If you're
Mm.
sitting just staring at Twitter all day, you got to go
Yeah.
get off the grid and live your life a little bit. So,
Yeah,
um,
yeah. This
yeah,
sounds this sounds already, Ross, like a good tip, just before we even get a proper dive into the markets discussion. But in all honesty, sorry for interrupting there. In all honesty, I'm I'm actually bringing this point because I've actually noticed a couple of your tweets regarding this get rich then get off the grid, and this is something that actually appealed to me very well personally, right? Which is,
Mm-hmm.
I cannot remember the exact moment that we kind of like started following each other, but I do remember that one of those viral tweets of yours actually just slipped somewhere, on my timeline, on my feed, and well, that did really work well. So so
Yeah.
eventually the effect is the result is that I had this great pleasure to be talking to you right now, and of course, just like we said, there are a lot of interpretations to what it does really mean to get off the grid, right? For me personally, it would be more of kind of like a nature vibe, somewhere over there, and then just leave the peaceful family life. But of course, to it, me being 28, you also being, we kind of like being, those age mates, if you will. There are many people who are actually, struggling for their entire life, and never reach their get off the grid, get off
Right.
the grid, kind of like time when you can get peaceful about that. And of course, the markets have not been really helping this either so far this year, right? So why don't we
Right.
cover a little bit of the markets and talk to me, Ross, talk to me for what is your kind of like strategy approach in 2022 that you've had so far?
Yeah, absolutely. I mean, 2022 has been a different year, of course, than the past, I would say, 2 years than we've really ever experienced. I think 2020 and 2021 were pretty much were very similar years in terms of the market trends and the things that were doing well and the things that were underperforming. And we rolled into 2022, and a lot of shift has gone on, and the sectors that are performing well are different than the sectors that were, the sectors that were lagging are now performing well, and the sectors that were performing well are now getting crushed. So there's a lot of uncertainty right now. I'll say nobody has a silver bullet or the answer that's just going to fix everything. There's a lot of concern with inflation and the global supply chain and global political tensions, and there's so many negative things in the headlines, which I think is very unnerving and hard to navigate. But it's a really good opportunity for new investors, or honestly investors at any stage, to build conviction in their holdings and learn how to things are never as bad as they seem. When things are bad, they're never as bad as they seem, and when things are good, they're never as good as
Mm,
they seem, right?
mm,
So it's a time to learn, and the learning experiences that you can learn during rough times like this will carry you further than just everything going up and you never learn anything, because reality is a lot of stuff's coming back down. And I'm guilty of it, and a lot of people are too, of getting involved in stocks that we didn't know maybe what the company did. They're super overvalued, and we chased it because everything was going up. And that's,
mm,
is we've all lost a little bit of money doing that, and not really ashamed of it, but it's just a good way to learn. And it helps you. If you can you build your investing strategy during tough times, because when everything's going up, it's just easy. You don't even have to
mm,
worry about it. So
mm,
yeah, so 2022 definitely, really trying to stick with dividend stocks and index funds and sticking to my core strategy. Because like I mentioned, the past 2 years, I definitely got involved with some names or some stocks that probably shouldn't have been in, lost some money, bought it really bad times, maybe didn't know what the company did, but everyone on Twitter was talking about it. And the stock just went up and up and up, and I made some money, and I probably should have sold, but I didn't. And then I held, and now they're getting crushed. So
mm. Yeah, I mean, if we look at it, like just like you were saying, some nameless stocks beat penny stocks, but in all honesty, you're looking at Netflix being 80% down of the peaks, right? Approximately. You're looking at Meta, Facebook being basically down like some huge deal amount as well.
yeah,
The entire growth kind of like aggressive, side of the market, risk barometer on, appetite kind of like has not been really in good favors recently. This is something that I had personally, have been watching, and me being mainly positioned in cryptocurrencies is something that, because of strong correlation and connection of how crypto connects to equities right now, it's all kind of like coming together, right? It's not really serving well. And you did say that this year is different. Of course, it's different. Every single year is different. But in all honesty, this is something that I hadn't really seen in quite a longer time. Just like you said yourself, that there's such an amount of uncertainty. Sorry, such an amount of these bearish headlines kicking in. Of course, the war. I'm saying, me being the Polish, Polish nationality, being the direct neighbor to Ukraine. Is Russia invading Ukraine is not really something that you see every single day, right? You don't really see. I saw a quote. I saw a tweet. Sorry, from one of the CMTs out there. Cannot remember the name, but long story short, there was like a proper study that these very 4 months into the year, into 2022, have been the worst performing 4-month opening into any year in S&P 500's history, right? We're talking about this. We're talking about the 42 downwards trend, kind of like 42-year downwards trend on the treasury yields, pretty much just picking up and then breaking to the upside. So we're talking about this. Like, to me, it does look, and I'm happy to hear your opinion, but to me, it does look that we're looking at a year that it happens once in generation, like once in 40 years, once in 100 years, something like that. That it's not really just like one of many, one of the sequence, but it is like this. If you were to put it, pinpoint in a decade or in a century, then you would definitely pin it there, right? This is what it looks to me. How do you feel about that?
Yeah, I mean, there's a lot coming together at once. You mentioned the treasury yields, and you mentioned the war and inflation and supply chain, coming through COVID, and interest rates rising, and yeah, you're right. There is a lot coming together at once, and things could really break bad if you know I see many different viewpoints, right? Of course, there's always the what if everything goes wrong, right? We would, there is a scenario where there is much more downside to this, and most of it is driven by headlines, which are out of the market's control, right? I mean, unfortunately, the Fed can only do so much, so whatever can do so much. But if there's more headlines about COVID or the war or something like that, well, then the stock market's going to react. And so it's already in a fragile place. So I certainly could see it, getting worse and being a more of a generational event. And I mean, even these past couple of years, I mean, the market has seen a lot of things that it hasn't seen in many years, or even in decades. And that is scary, of course, but that's also where a lot of wealth is built, is in the uncertain times, and taking risks and making bets, and of course, calculated risks, or maybe not as much calculated. But these are the times where you look back in 10 years and you're like, oh, I should have bought that, or oh my gosh, like there was all this uncertainty and I was so scared and I just sat around and did nothing. And then in 10 years, we're eventually going to get out of this, and whatever the future looks like. But at the moment, there are companies that, I mean, there are great companies that are getting caught up in these sell-offs, right? There's companies down 50%, and these companies are the future. I mean, if you want to look back at any mega cap stock, they've had 50% sell-offs. Every single one: Apple, Tesla, Amazon, Facebook, Netflix, you name it, they've all had 50% sell-offs before. And that is just the nature of the higher risk names. You're going to have some more volatility during the tough times. And so I get it.
I think
it's nobody has an answer, and it's hard. I mean, it's hard.
Yeah, it is hard. Yet I can wholeheartedly agree there, and it still does somehow seems, it does seem a little bit more, a little bit harder than usually. This is my kind of like view. And there's also this kind of like a seasonality point, I think, in a map, that you get these midterm election years, right? And from what I best researched, the midterm elections, cause a little bit of stagnance more often than not in the markets, as in you don't really
Mm-hmm.
see so much of an upwards pressure anymore, and it usually either returns flat performance or kind of like negative, as in it either chops around with little to no performance whatsoever. It kind of like averages a flat, or
Mm-hmm.
it or instead it kind of like continues something that had been going on for some time, namely the bear markets, right? So
Mm-hmm.
well, this is uh, there's just a lot of, I should say, a lot of dark clouds that are coming all together, just like you said, not only from the supply chain, COVID, and then so on, but there's like this market embedded kind of like risks just of this midterm seasonality. So Ross, why don't we talk and move the discussion a little bit more into the future for what's 22 potentially bringing ahead in your eyes, in your opinion. Well, if we were to talk about where equities, of course, commodities, crypto, any market pretty much you like to cover. Now I'm super curious of your thoughts, well, for what may be ahead, to start it off with equities.
Yeah, absolutely. You know, like I mentioned, there's a lot of stocks that are down a lot. I'm not one to make any kind of predictions over a month or 3 months. I'm talking 6 months to a year to even further out, right? I can tell you that companies are still operating, right? People are still going into work. People are, everyone's going into work. People still are living their lives, and these companies are still performing. Now
Mm,
the stock price is not correlated to how the company is doing, right? So my example is I work in cloud and cybersecurity, right? People still need cybersecurity no matter what. If the internet exists, people are going to need cybersecurity. Cybersecurity threats are growing every single day. There is no denying it. There's a huge labor shortage in cybersecurity right now. There's 100% employment rate. If you have a degree or any kind of knowledge in cybersecurity, you're going to have a job. Every single company is
sure.
hiring, no matter what. There's a huge demand. So personally, I don't really care what the cybersecurity stocks do in the short term. I know in the long run, people need cybersecurity. The companies are going to
Mm,
perform. The companies are still operating, right? Whatever name. I mean, SentinelOne, CrowdStrike, Palo Alto, Fortinet. I mean, there's a bunch in that industry. But that's just one example of people still are buying cybersecurity. It does not matter what the stocks are doing in the short term. In a couple of years, these are the kind of names that where the stock price becomes detached from the actual company's performance. You're going to look back and say that was a no-brainer buying opportunity. Why didn't I buy it? Right.
mm,
So that's kind of what my outlook is going forward. Is the uncertainty is hard, and it's hard to buy, and you don't want to buy right now because it's hard to buy stuff when it's down because it's just
mm,
emotional. So I try to detach emotions from recent performance and say, okay, what are the trends that the world is shifting to, and that is work from home or really work from anywhere, or pushing things to the cloud as opposed to storing data on a physical server on premise, and how are we protecting that data, cybersecurity. The world is shifting that way in every industry, and it seems like every industry is already there, but that's just not the truth. There are so many industries and so many businesses operating still on old technology, right? So I work in the tech field, so I see it every day, right? Um, but I can tell you that you even want to look at some of the companies that I hold and that I favor, some dividend stocks, but like your trash is going to come every week. Waste Management picking up your trash. People are still going to shop at Home Depot. People are going to still, the line is wrapped around at McDonald's and Starbucks, and these companies are still operating, performing. So good, well-run companies with a history, track record of long-term success and ability to navigate any headwind that comes their way. I want to bet on them going forwards. So there's a lot of names that I could throw out. but I do look at past performance and the
Mm-hmm.
leadership and the management and how these companies have pivoted and handled scenarios that have come their way. I mean, COVID was a great example of which companies pivoted and excelled, and which companies were lagging. And it's no different this time around. So, for the rest of the year, I mean, I believe the market's going to recover. Stocks are going to recover eventually.
Mm-hmm.
I don't know when, but I can tell you that there are still good companies out there, still doing their jobs, and good companies are going to win in the long run.
True.
That's just bottom line. Good companies.
True. I fully endorse this kind of like way of thinking where you actually just put forward this longer term kind of like idea, this longer term scope over any shorter term kind of like speculative movements. People would always, from my experience, from my observations, people would always, as traders, try to pinpoint the perfect bottom, the perfect top, of course, right? So they would try to short each 500 times until they kind of like short the very bottom. Being realistic, right? And they would always kind of like try to squeeze as many shorts as they can down as the market just keeps climbing down, keeps going down. But at the same time, they do risk of actually just meeting this wall somewhere over there, be it on the downside or even on the upside, right, where people keep longing relentlessly. And all that makes me think that if if traders keep doing that on a regular basis, as in with no control, no kind of like consideration, no consideration to their like performance, if it's really working well for them, like just like you said, when there is a mania phase, when everything is going up, it's easy to make money, but then kind of like boom, right? Just like Mike Tyson said one time, that everybody has a plan until they get punched in the face, right? So the market often punches you in the face, and you kind of like wake up that it's already too late. And those stocks, as they were climbing so high and so fast, they are like literally tanking so fast in the opposite direction. So like, of course, equities, I do sense that that the equity side of the market is the one of your interests mostly. But do you also happen to invest, aside from growth stocks, in some crypto stocks, or because there are some cryptocurrency kind of like based ETFs, or stocks, or the companies just like Coinbase Coin, of course, with the ticker, or some other commodity stocks? Do you go abroad versus the growth stocks?
Not a large percentage of my portfolio. I own a very small amount of Bitcoin and Ethereum on Coinbase, but I'm not factoring that into longer term, but more of a mindset of, all right, I own some, I've dipped my toe in, and kind of learning and educating myself and building conviction. Right. I don't want to go into it with no conviction just because everyone else is, right? And if I miss returns, that'd be fine. But I'd rather learn. And so I own some, and so I track it more and more than I ever did, right? And is not anything I'm opposed to, but I see the adoption of cryptocurrencies on a global scale, right? Big companies are adding it to their balance sheets. They're finding ways to utilize it and have it bring value, right? What kind of value does crypto have? And so as it keeps shifting that way, I want to be in it, right? I'm not going to leverage a large percent of my net worth or my portfolio, but if I put 5 or 10% or whatever the number, and it does great, that can be awesome. And if it doesn't, then I've got other ways to generate return. So
yeah, if you think about it, I mean, 5-10% is still high enough if you don't really like overall, if a trader does not commit wholeheartedly to understand, just like you said, the very merits, right? So if I were you, I'd probably do exactly the same, as in, you from what you're saying, I can somehow just deduct that you taking it a little bit slower, not really pressed by the market itself, just trying to understand and learn the mechanism, the concept, well before you actually increase any exposure in future, right? So it does seem way more reasonable, if you ask me, than getting 100% basically all-in investments that just like you see across the Twitter. You know, I'm pretty sure your followers as well, even just taking, you know, pure statistics, there's always going to be somebody who's literally going relentlessly all in or all out, you know, every single day in the cryptos or the stocks or whatever other
Yeah.
market there is. And it doesn't really well serve in the long term, that's for sure.
Right.
Do you happen to also, you know, have a look into commodities sectors, if you will, or not?
That is not something that I've explored too much, but I know it
Okay.
exists, right?
Okay.
But haven't
Okay.
added that in yet.
Got you. Of course, you know, there's a lot of, like, I'm asking because I'm personally I'm very much intrigued by the performance of commodities over the past year. And for everybody
Hmm.
who's actually, you know, watching this very podcast, to all our viewers and listeners, we're talking about, just for instance, Bloomberg Commodity Index, which actually, you know, is mainly exposed to the energy market and to the precious metals, in about covering more than 50-60% of the entire index value. And well, driven mainly by the high oil prices, by high gas prices, by somewhat higher gold prices, although relatively flat still. You know, we were looking at a very high, very strong increase and very strong momentum increase inflow ever since the last year at the same time. I remember, for everybody's notice, I do remember that on February 2021 we were looking at a very significant reversal, um, that I happily and likely was actually, you know, tweeting about a lot. And this index actually was about to break in February 21. It was about to break for its 50-month moving average, for its 50-month reversal, kind of like a confirmation, and it finally did. In the February was the first candlestick, was the first kind of like a signal that that hadn't happened before in over, I can, as far as I can remember, 12 or 14 years. So it, you know, such long lasting kind of like trigger signals often lead to huge implications following that. And just 1 year later, we're looking at 60-70% increase on average, right? So this is an average performance. So if there is such an average performance of this strength, then it means some outliers that are actually just pushing, you know, this growth strongly are somewhere way higher. And this also connects to the stock market, of course, somehow, because there are a lot of mining stocks, you know, gold miners, silver miners, copper miners, all of that. Oil, of course, oil stocks, you know, were really performing very high, especially after Russia Ukraine kind of like war triggered. But all that just, you know, makes me think that the more vertical it always goes, the more vertical it's always going to drop following after. So there is definitely a lot of caution to be held and to be suggested. And after this long elaboration from my end, I definitely want to pass over the microphone to Ross right now. And Ross, if you are so kind, talk to me and to our viewers and listeners a little bit more about your, well, more detailed kind of like strategy plans, like, because we know that you do focus on dividends growth stocks. So
Hmm.
on what basis do you actually value them? Is it fundamental evaluation? Do you do some discounted cash flows? Do you actually just do some crazy like legendary, you know, ways of measuring, just like you look at p price to earnings or price to book value sales and so on, or more technical issues? Talk to me about that.
Yeah, so my strategy mainly revolves around, dividend growth stocks and index funds.
Hmm.
So when I say dividend growth stocks, I'm not talking about growth stocks that happen to pay dividends. I'm more so interested in the stocks that are growing their dividends. So the
Hmm.
dividend is growing, hence the name dividend growth, right? So companies that raise their dividends, you know, historically the strategy has been companies that raise their dividends faster than the pace of inflation. That way, the money that I'm getting is worth something. That has been tricky lately. No strategy is going to work 100% of the time. But
True.
that is the goal: is to find companies that are raising their dividends 10, 15, 20% per year over the long run. That way, not only are you getting capital gains from the increased share price, but you're getting a raise in dividend. And I'm 24, right? So I'm not doing this for income. I'm not doing this for any kind of income stability to live off of. It is more of an overall reinvest those dividends back into those same names and let the snowball compounding effect take place. So typically you're finding dividend growth stocks in companies with longer track records of success of navigating volatile times. The stock prices are normally a little bit less volatile than some of the names that don't pay dividends. And the handling them emotionally helps you have longer term conviction when you're looking at really strong companies with long track records of success. When you have uncertain times, you can look back at how the companies have handled tough times, and that can give you conviction to hold. I know when stocks start tanking, it's really easy to want to sell, especially when you're in some growth names. I've done that. We've all done it, right? The stock, you're in some growth stock you don't really know a ton about, and it's down 50%. You're like, oh, you just sell it, and you're like, I don't know what to do. But when you own companies that you know what they do, I always say invest in products places you shop at, or things you use every day. You kind of your long-term performance is there because of you have a lot of conviction in the names. And so I find a lot of performance in names like that. So when I'm looking to buy new dividend stocks or even add to current ones, there's a couple of things I look at right off the bat. The first thing I look at, the quickest one is probably just dividend yield, right? As the stock price goes up, the dividend yield goes down, because dividend yield is just a metric of annual dividend divided by stock price. So I tend to look between 1% and 2%. Anything less than 1% is going to be a small dividend. And I mean, like, you think about like Apple and Microsoft and some of those names, like, they pay dividends, and it's cool, it's nice, but like, they're kind of like a gray area. So less than 1%, kind of iffy for me. So between 1 and 2, or even up to 3%, is where you're finding companies that are growing their dividends a lot. Anything over 3%, you're typically finding some REITs, some real estate companies, or just slower growing companies that they pay bigger dividends, and the stock price isn't growing as much, right? So obviously I want the stock price, the capital appreciation of the stock price, as well as the growth of the dividend, right? So I look at the yield, just an easy metric. I would say between 1% and 3% is kind of the range that I like to live in. So a good metric to just really quick evaluation is you can look at a stock's historic yield of what it trades at. So take Home Depot, right? It's long-term, you can look at 10-year, 20-year average yield is like 2%, right? So if Home Depot is at a 1.5% yield, you say, okay, the stock is probably a little overvalued right now, or it's had a good run up, it's probably a little overvalued. Or if the stock drops, right, and if it's trading at a 2.5% yield, it might be a little undervalued, and it's trading of less at a premium than its historical average. So I tend to keep up with that, especially with companies that I already own. Is what is their historic yield? What do they normally trade at? How does the stock price and the dividend raises compare? And that's just a quick way you can use historical data to find anything that's undervalued. And the next thing I look at is dividend growth, right? So I like to find companies that are raising their dividends faster than the pace of inflation, which historically has been between 2% and 3%. Right now, it's much higher. So there's plenty of companies that have a history of raising their dividends more than 10% every year, which is awesome. There's a lot of wealth that is built in that. Warren Buffett is a great example, but there's plenty of legendary investors who have built a lot of wealth just through the growth of the dividends, reinvesting those back into the growing stock price. Right. So, history of dividend payouts. I mean, you've got dividend kings that have raised their dividends for over 50 years consecutively. So think of everything that's happened in the past 50 years. There's companies that have still raised their dividends. Now it might be a penny, which is why it's important to look at the dividend growth and things like that. But they have consistently raised their dividends. So that should give you confidence that they are going to continue to raise their dividends. Of course, past performance does not guarantee future results, but that is a good indicator, is looking at length of dividend payments. Like the Kings are 50 plus, the Aristocrats are 25 plus, and there's a few other smaller categories within those. But length of dividend payout, dividend yield, and then I like to look at the payout ratio as well. And this is another metric that it just shows that how much of their net income or their net earnings that they're keeping for themselves versus they're paying out in the form of dividends. So I tend to look for companies with a dividend payout ratio between 30% and 50%. Of course, there's exceptions to every rule, but hypothetically, say a company is paying out 50% of their net income in dividends, right? So then they've got 50% left to reinvest back into the company and grow that way. But if a company is paying out 70% in the form of dividends, well, that can be a little concerning that they're paying out too much of dividends and they're not keeping enough cash for themselves to either grow the business organically or just have cash on the balance sheet for when things get hard, right? So there's a lot of safety built in when you've got a safe dividend payout ratio as well.
The quick interruption. If something this just struck my mind. If something seems too good to be true, it probably is. Right? Just like you're referring to those 70% dividend payout ratios. I mean, it sounds catchy, right? It sounds catchy.
Right.
You have to admit that many people will probably fall for it, right? Especially when not really doing too much of due diligence prior to it. But it's something that's really sound too good to be true. It probably is. This is something that
Right. Yeah, absolutely. And I mean, dividends on a very basic term, every quarter companies report earnings and they have cash, right? So they have two options with their cash. They either need to keep it for themselves and grow the business, therefore they don't pay out dividends. So think of like Amazon or Tesla or whoever. They use the cash for organic growth or M&A or new expansions, whatever. Well, you find more mature companies, they've got cash. Well, they're not as focused on that. Their business is just kind of operating as normal. So they're paying out some cash to shareholders and they're keeping some cash, right? And so you just need to know what how your company makes money and what they do with the money that they're making. And that's dividends, right? I mean, it's just about cash. It's just how the company is using cash. And if you can give some to me, I'm going to put it back into your business and hope that there is still growth. So the dividend payout, right? If you're giving me too much cash, I don't know how safe future payouts are going to be, right? So I'm not chasing a really high payout for short term. That doesn't really help me in the long run.
Yeah. Besides, what makes what actually just comes to my mind when you see some very, very high dividend payout ratio, it kind of like resembles some sort of like Ponzi schemes to me, like more often than not, right? It's like, of course, if something seems too good to be true, it probably is. And in those terms, if something then is really offered at a very high stake in terms of like the payout ratio, the amount of dividends, of course, then there must be some some strange shady background mechanism perhaps if the company still operates, right? So lots of Madoff pyramids and Ponzi schemes would probably be what you're looking at in those cases. And even if not, it still should raise certain concerns, right? Doesn't it?
Right, exactly. And the only other thing I do want to mention is there is a category of investments called REITs, so real estate investment trusts. They are legally obligated to pay out 90% of their net income in the form of dividends. That is a structure that they are set up at. So you will find those companies with nice yields and good dividends, but the payout ratios will look a little weird because they're not keeping a lot of cash, right? So
I didn't know that.
Yeah. So if you're looking at REITs, that dividend payout will look a little weird, but that's how the company is structured, and it's purposely structured that way, right? So that is planned for the company to have it operate like that. But besides that, You don't want a normal company, anything over,
yeah.
that high would be crazy.
Yeah. You always need to account for and adjust for the certain category that you're looking at, right? Of course, in
Mm-hmm.
cryptos, just like you would compare some passive income, you would often see some crazy returns from like from well those liquidity pools. Like, not really getting too many details right now there, but of course there is a lot of entire separate subject to be discussed one day maybe about the how how large of a percentage compared to stocks, of course, you're going to see and have a look in crypto. This also comes with volatility and with risks. The higher the returns, the higher the risks lying under. So this is always something very universal in those terms for sure. And getting the very near end of the show with Ross, with Dividend Hero, to everybody's notice. I'd love to get some one or two final questions, quick ones. They're going to be quick ones. But do you have any hobbies that you actually just share with your friends, with your family? Talk to me about that very quick.
Yeah, absolutely. Well, I love to fish, right? So I grew up fishing. The neighborhood that I grew up in had a couple ponds in it, and so that's what me and all my friends would
Nice.
do, is get together on the weekends and go fishing. And so that's kind of grown and transformed over the years, right? So now I fish a lot with my dad. There's a couple lakes near us, and so we have a boat. So especially this time of year in May, it's really warm here, so it's a great time of year for fishing. And so definitely a hobby that I get to enjoy. Get off the grid a little bit, enjoy a Saturday with my dad, and just get out on the lake. And I love to catch fish, and I'm a pretty good fisherman. But I love being outside and soaking up the
Mm.
sunshine and just getting away, and spending time with my dad, being out in nature. It helps me break away from the weekly grind. So
Mm.
I always have a good time either way. So definitely a hobby of mine. Definitely not a competitive fisherman, but so yeah, I love to fish. I love to cook. Um, I'm a pretty good chef. I make all kinds of stuff, but I'm always learning new techniques and new foods. And I like to cook steak. I like steak, but
Nice, nice.
I would definitely call myself a foodie. So definitely like to cook, and I'm always looking at recipes and watching cooking videos and learning all I can. So I'm a pretty good cook, and I love to fish, and yeah, just you know
And
getting out of
that's why that's why you exactly built the fisherman restaurant, right? For a joke.
exactly.
Because
That's
there's
how I know
certain
that
bridge.
quote.
There is a bridge. Yeah.
Right, absolutely. So those would definitely be my main two hobbies: cooking and fishing. You can usually find me doing one of those two.
Yeah.
But I love sports. Love going hiking and traveling. I love exploring just you know cities and towns around me. And um, yeah, so that's
Love
kind of
it.
me. And
Love it.
if I had to pick a few, that'd be those.
Nice, nice, nice. Of course, it somehow clicked in my mind when you said I love to fish and I love, cooking, chiefing, and it's well, fish restaurant, fish and chips,
Yes,
right?
of course,
Just somehow
of course.
connect with a lot of beautiful fish dishes. Of course, of course. This is something that I definitely endorse, and if this is your way of getting off the grid, then well, let it serve you well and better.
For
Finally,
sure.
I'd love to hear from you, for all of our listeners and viewers, real quick. One kind of like main golden tip takeaway that you'd like to leave our listeners with.
One takeaway. That's a great closing thought. Let's see here. I would say that I said it earlier, and I'm going to say it again. But when things are bad, they're never as bad as they seem, and when things are going really good, they're never as good as they seem. Right? So don't buy into the fear. There's a lot of, especially in the markets or just in your life in general, when you think things are going really bad. They're never as bad as you make them up to be in your head, right? we're all going to get through this together, right? And when things are good, enjoy the good times, but don't think it's the the absolute greatest thing in the world. Stick to who you are, stick to what you know, especially in your investments, and always learn and always be open to new opportunities.
I love it. I love it. Great summary. Ladies and gentlemen, to our podcast, to the Nestro podcast, beautiful personally came over, known as Dividend Hero, Ross, coming for the entirety of the knowledge that he's shared, for the entirety of the wisdom and tips that you guys have heard. Make sure you go and follow him on Twitter at Hero Dividend, at Hero Dividend. That's his handle. You're going to find him there. I fully endorse and support Ross on that, and I think you all should do, especially for the amount of knowledge that he's just shared with you. Thanks so much, Ross, for coming over, and I hopefully see you on the next show anytime soon.
Yeah, absolutely. Thank you for having me.
Amazing. On to the next show, guys. Cheers.